I was very, very fortunate to pick stocks almost at the bottom. And people always ask me, and so I had some very famous bottom calls. One was Western Wireless, which I upgraded at $1.76 the day of the low, and it was acquired by Altel 18 months later for $40.
Hello everyone, this is BTC Insight, and welcome to yet another deep dive into BTC Insight. Before we jump in, make sure to hit that like button and subscribe if you haven't yet. You won't want to miss this.
In a world where financial markets are constantly shifting, where headlines spark panic and euphoria in equal measure, and where investors search desperately for certainty, one man has built his reputation on clarity, discipline, and bold calls: Tom Lee. Unlike the countless strategists who hide behind probability models and vague scenarios, Tom Lee believes in putting a single confident number on the table, a target investors can use as their compass. But how does he do it? What lessons shaped his approach? And why does his perspective still resonate even after decades in the market's trenches? In today's deep dive, we'll explore Tom Lee's philosophy of market forecasting, the powerful lessons he drew from his early career in the wireless industry, and the strategies he's used to identify bottoms, manage risk, and challenge consensus thinking. By the end, you'll understand not only how Tom Lee makes his calls, but also what you can learn from his framework as an investor navigating an uncertain future.
It's especially difficult knowing that there's really never equilibrium. It's not like the stock market cashes you out at the end of 2024, but we're still trying to figure out where the market level would end up being. Most people who follow and forecast markets tend to do what you just described, which is they give you 3 or 4 scenarios, and they'll say, well, there's a 20% chance this happens, and a 40% chance this happens, and a 20% chance this happens, and so my average target is this.
Right.
I think the flaw in that is that you're now trying to assign precision and probability to 3 different events, and I don't think our clients want that because it's confusing. So we tend to stick with a single number. And the way we develop that single number is everything you've described. We look at what could the PE be, what could the earnings power be, where could the surprise come from, how much will liquidity matter, and how much would risk appetite matter. And sometimes risk appetite is the most important thing, sometimes earnings. And then we actually have to use judgment to decide which one's the most important and come up with a single number. So I would say our targets aren't science, but it's where we're the most confident that that's the most probable path. And it's a process we've been doing since 2009, actually since 2008, and it's actually worked pretty well. I know when I was at JP Morgan, for the first 6 years, we had identified the closing price for the S&P 5 of the 6 years within 1%. Now, It's not that accurate anymore, but in the beginning, the process worked well for us. An example is, at the start of this year, we thought the S&P could get to 5,200, but that was in December 15% upside. But not only was the stock market strong in December, we always established the target in early December. Not only did last year, December 2023, the market rise a lot in December, but it was strong in the first half. So 5,200 won't work as a target, as a static target, because that's a 13-month target. But it's directionally correct, because at the time, 5,200 was the most bullish view. The few things I learned in wireless was, I think, pivotal to how I view markets. I mean, foremost, the wireless industry didn't generate money. The industry was always borrowing money. And so we had to develop a way to actually value the stocks, the equities, without earnings. And for most of my first, let's say, decade of that career, most people I met would say, Tom, the wireless industry is worth 0 because they don't make money. But we'd always be like, well, what is the value of their subscribers or the spectrum they own, because they aren't capitalized on the balance sheet. And eventually they make money, but they have to spend marketing dollars to acquire the customers and build the networks. So it was really during that period that I learned a couple of things. One was that you can follow what the bond market is doing to know if there'll be moves in the stocks. So I learned to call our high yield desk every day and ask them the levels of different companies and were they trading better. And of course, if a bond started to trade well, then that meant that the bond market sensed something was improving, and therefore the stock would react. And so that was very helpful. And it really taught me to look at stocks as the junior piece of the capital structure. Whatever bonds are doing, stocks will follow.
Right.
Another thing I learned was how important the intangible value of an equity is, because in the wireless industry, they had to front load the cost of building the network and then acquiring a customer. So they didn't make money until 1 or 2 years later. And the wireless industry operated as what you'd call a long-term greedy business. They weren't trying to make money in the short term, but all the investment they were making created value in the future. I mean, that's today pretty widely accepted as the lifetime revenue of a customer, or we call it long-term greedy. And that's, a life lesson that you really shouldn't try to maximize how much money you make now. It's more important how much money you make over the cycle. And that's how we look at the equity markets. I think the third thing that really puzzled people was that when I was a wireless analyst, and I became pretty well known as a wireless analyst. In fact, I became institutional investor ranked only 2 years after starting coverage of the stocks, which made me, I know at Smith Barney, I was one of the youngest managing directors. I was 28 when I became a managing director there. And I was very, very fortunate to pick stocks almost at the bottom. And people always asked me, and so I had some very famous bottom calls. One was Western Wireless, which I upgraded at $1.76 the day of the low, and it was acquired by Altel 18 months later for $40.
Wow.
And I upgraded Alamosa Holdings, which is a Sprint PCS affiliate, at 37 cents, and it got bought by Sprint for $22. So these were hundreds of times returns on investment for stock upgrades.
Right.
And people ask me, how am I picking bottoms in stocks? And what I have shared with my friends but never shared with my clients was that the stocks I would upgrade was based on me talking to all of my clients. And at the time I might have 70 or 80 clients, so it wasn't hard to talk to everybody. And the ones that they were the most bearish on were the ones that I would upgrade. And the ones they were the most bullish on were the ones that I didn't think would work. And it's an example of how consensus gets crowded. So I use those same principles today when looking at markets. So for instance, we found that when people panic about inflation, and I have a chart that we share with our clients, but it's happened 5 times since October 2022. When inflation expectations hit 4.3% 1 year forward, it has always marked a tactical low for the stock market because people get overly worried about inflation. So there's a lot of signal that still comes out of realizing what becomes crowded.
But being contrarian isn't easy. Lee recalls one of his toughest calls, placing a sell rating on Nextel in 2004. His analysis revealed low-quality customers and questionable accounting practices. The backlash was intense. Clients were furious, management labeled him hostile, and even his own firm pressured him because Nextel was a major investment banking client. Eventually, Lee was proven right. Nextel was acquired, and its weaknesses nearly destroyed the acquirer. Hedge funds congratulated him after the fact. But as Lee reflects, it still felt like a loss. Why? Because being right didn't repair the relationships lost with clients who had ignored his warnings.
I went to a business school undergraduate. I went to Wharton as an undergraduate and graduated, and my first job coming out of college was at Kidder Peabody, which was a stock research firm. And I was very fortunate to have been assigned. When you get a job in research, you don't pick the sector, but I was assigned to the wireless industry, which in the early 90s, it was in its infancy. There were only 34 million cell phones in the early 90s, and today there's 7 billion. Right. So you can imagine that that is a hyper-growth industry that has grown faster than even the internet. The two that I always think about in the back of my mind, one was from 2004. And it was a long-running story arc, but in 2004, I turned negative on a wireless company called Nextel. And at the time, we were doing a lot of analysis of balance sheet quality and the quality of customers. And what we found was that we thought that this company's subscriber base wasn't as high quality as they claimed because of changing policies around churn and the way they capitalize certain items. And so we put a sell rating on the stock. And it became a very public battle with the management of that company because they viewed us as hostile to them, naturally, because we had a sell rating. And they were also a big investment banking client of the firm I was working at. So I was getting a lot of pressure to say favorable things about them. And a lot of my clients actually turned on us because they were angry that we weren't recommending a stock that they owned. But so we stuck with our negative rating. Eventually, the company was acquired by another company, and it turns out many of the things that we thought were quality issues basically came to light, and the acquirer almost imploded because of that. So in the years afterwards, so many of my hedge fund clients said, "Tom, you nailed that call. I can't believe that you saw these things before anyone else did." Yet, to me, it was a huge loss because we had so much damage to our relationships. You know, people were they hated us for years that we didn't recommend a stock that they owned, that I was like, like having a sell rating, it's tough because you end up making enemies, and if you're right, they're not going to say thanks because they lost money on a stock. So I learned that it's very tough for investors to accept this idea that someone's trying to make you money. Like, our business is to try to make our clients money. We're not trying to be right. So that, to me, was very eye-opening. And I'd say that the second thing that sticks in my mind is being wrong. And, you know, we've been wrong a lot. We're going to be wrong a lot just because you can't get every call right.
Sure.
But I would say that it was really early 2022 that I regret not paying more attention to Mark Newton, who is our technician. So at my company, we have different silos of expertise. So I do macro research, which is fundamental analysis. We have Mark Newton, who does technical research, and he does cycle work, and it's very involved. You know, he looks at so many different chart type models, whether it's DeMarks or stochastics or Fibonacci's or even other longer term cycles, liquidity cycles. We have a policy strategist and we have a crypto strategist named Sean Farrell. Well, in 2022, Mark had warned me. He's like, "Tom, the market has gotten really weak." So at the start of 2020, he said, it is a really thin market and it's very tenuous. And so he thought we would be down more than 10% in the first half. And we were cautious in the first half of 2022, but we thought if you were down 10, you'd buy that. But he was adamant. And of course, we fell more than 10%, and Mark was still bearish. And he turned less bearish around August of 2022, which was the market's internal bottom. So that really taught me, and this only happened a couple years ago, that, you know, liquidity and technicals, they can be so variant from what is common perception that you have to pay attention. So, you know, subsequent to that, Mark and I work really closely, and I was like, "Mark, just, you gotta warn me. Next time you think there's a big drawdown coming, we should spend a lot of time figuring that out." And so, of course, that's what we did.
Tom Lee's journey is more than the story of a successful strategist. It's a playbook for anyone who wants to understand markets with greater clarity. From his early lessons in wireless, valuing intangibles, following bonds, and thinking long-term, to his contrarian calls and humbling mistakes, Lee has built a framework grounded in conviction, adaptability, and respect for the psychology of crowds. He reminds us that forecasting isn't about pretending to know the future with precision. It's about judgment, about recognizing signals others overlook, and about having the courage to make a call when the crowd is paralyzed by uncertainty.
That's it for today's look into BTC Insight. If you enjoyed this deep dive, hit that like button, drop your thoughts in the comments, and subscribe to stay on top of all the latest insights. Keep questioning, keep learning, and we'll catch you in the next one.